Yeah, Wednesday. What's up, everybody? Wednesday morning. Hope you guys are having a great day. Welcome to today's edition of the Daily Market Commentary. I'm your host, Chuck Fulkerson. We are down big this morning. I say down big. We're down about 1%. But 1% is a bigger number than it used to be, as the S&P is down 41 points this morning. NASDAQ's down 200. We're going to do what we do each and every day, looking at our big picture market opportunities. So let's go ahead and get rolling. We talked about this on Monday, about the simple fact that if the markets put in a lower high on the daily chart, that it was going to be a significantly bearish picture, right? And so let me get rid of these open interests. And I'm using the NASDAQ as my example because the NASDAQ is the one that I specifically had spoken to. Now, we had spoken about the fact that, to me, the most bearish thing the market could do was to bounce off this area of demand and then come higher and then make it to supply and then roll over. Well, we didn't even make it all the way up to supply. And we have put in a confirmed lower swing high. Now, I don't yet have a new lower low, but if I look at my last 3 consecutive lower swing lows, here's one, here's one, here's one, and then I've got 3 consecutive lower swing highs. Here's one, here's one, here's one, right? So, I mean, we have a definitive downward trend that we can track, and it's a bit of a trend channel, right? And so now, where did I say that our next stopping point looks like it would be if we get lower than our prior swing low? Well, in my mind, you would then look to the S&P level to find the S&P level's next quality area of demand. Now, why the S&P? Well, because the S&P is certainly going to be where I'm going to identify my strongest demand zone. So, looking at this on a daily chart, if the S&P gets in this new lower low, now see, the S&P hasn't put in a lower high and a lower low. It's just put in a lower swing high. I would say that the S&P demand level comes into play down here at about 39.50, right? 39.60 actually would be our next S&P demand level. So that's still another 80. It's still another, what is that? 120 points that the S&P has until it reaches that area of demand. And so until then, we're going to continue our bearish stance, our overall bearish movements. I mean, that's kind of what we've been looking at now for a while, especially in the technology sector stocks. Those of you guys that are members of Traders Army, last week on Thursday, we looked at a significant number of stocks from a bearish perspective that gave us all decent entries. And that's kind of what we're still seeing. So let's look at the S&P from an hourly chart. So we talked about the breakdown of this area here on Monday. We did get a little breakdown from that level. Price came down to our area of demand, and we got a little rally away from that zone. So that was a pretty good little trade for those of you that were able to take that. If you did not, there's no trade left there, obviously, because we traded through it. I'm going to look to this little wick over wick area here as my next quality area of supply if price does indeed come back into that region. We are in the S&P on our 4-hour chart. We were kind of meh on our trend, but we did put in a really nice double top here, and that double top is definitely a signal that we've got a lot more weakness ahead of us and price can continue to fall. In the NASDAQ on the hourly chart, taking a look at our NASDAQ hourly level, we definitely traded into our zone of demand and rallied up off of that level pretty well. So we had our breakdown trade from here into our demand area, and then price rallied up off of that level. So those of you that took that, hopefully that one worked out pretty well for you. Now, if we get a bit of a rally this morning on the NASDAQ, I'd look right up in here as my rally level, 13,137 by 13,169. You do have this wick over wick area here as well that's still going to have a lot of validity to it. But I'm looking at this one because this is our London Open, right? We're going back to the start of the London Open here, which is definitely one of my favorite times of the day to look for levels. So overall, from an equities market perspective, I would continue our overall bearish sentiment. Um, we looked at a couple of bearish markets, some stocks themselves that are going to kind of continue that trend. But when you look at the Nasdaq, the fact that the Nasdaq's falling, you can always go to your, your call them your FANGM stocks: Apple, Facebook, Microsoft, Amazon, Google, and Netflix. And in looking at all of those, for example, here we have Apple. We had a decent hourly level here of demand in Apple, and we hit it, got a nice little move away for a 2-to-1, and then we broke through it, and now old demand acted as new supply, and now we're breaking through there and continuing to fall. So looking at that on a daily chart, I mean, look at this. We've got lower swing highs, lower swing lows. It is the picture of a downtrend in Apple, which we don't say that very often about Apple, but that's really where it's looking to be the next move down. I've had a lot of people say, "Well, listen, I want to buy Apple at a significant discount." Great, go find an opportunity, but your areas of demand that are highly probable. I mean, you've got a little level here at 120, but beyond that, your next best level is not until. I mean, your best level is the gap fill area down in here. So there is an opportunity to take advantage of some of these stocks at lower prices. We just have to be patient enough to wait for price to get there. I mean, here's Facebook. Also, lower swing highs, lower swing lows. We've come back into the gap fill area and traded into the gap, but not all the way through it. Looking at Microsoft, which is oftentimes going to be one of the strongest of the three, especially because it's the large, as a large cap, a little bit more mature of a company. Microsoft sometimes doesn't take as big of a hit, but it's also coming down pretty hard. Amazon in its retail sector. This was the area that we'd looked at in Amazon a while ago, was a pullback into this area of demand. Unfortunately, we came close to it without getting in, which makes it a little bit less probable, but I still think that's a potential in Amazon. Yesterday, Amazon put in a little bit of a bearish engulfing candle. So anytime you see a bearish engulfing candle, anticipate price dropping. And it looks like this morning we're going to open up right about here in Amazon. So that would be a gap and go trade potentially in Amazon. So my point being is that there's a lot of trade ideas out there on the short side as the markets are giving us kind of that picture. When I look at crude oil today, we have a huge, we have this one big candle, this long wick that came right through our demand area. As we got decent basing here, popped above for our breakout. 1, 2, 3, 4, 5, 6 candles later, the market had gone nowhere, telling us, hey, this trade's probably not going to work. And that's exactly why we have the 6 candle rule. And then we came down, saw this really long wick here, and it popped through a 15-minute area of demand. Now, that 15-minute area of demand wound up working later on for a little move away, and now we're basing in front of the next level. So with that basing, I've got to remove this level right here. And come into a smaller time frame, I would look at this here as a potential reversal. And then gold also popped through our confirmation short. No surprise on that, as we are continuing our bullish momentum to the upside in gold. I actually still like gold more bullish as we continue to trade higher. We're a little bit bearish today, but if we can come down to this hourly level of demand, you might have decent entries further on. So I'm not looking for shorts in gold. I'm still looking for longs when price comes back into these quality zones. So that's what I have for today. Make sure that you're keeping an eye on where the markets are moving this morning, because we do have a fair amount of bearishness that's coming into play. And if you have any questions, as always, send me an email, support@tradersarmy.com. Until tomorrow, everybody, I hope you guys have a great day. See ya. Hey, thanks for joining us. If you like what we do, please make sure you hit that subscribe button. It's the only way the computers know that you're actually alive and really care. And go to tradersarmy.com today to learn a bit more. And if you want to see some of our other videos, click here in the box.